Let's talk about a question that's been whispered in the corridors of power and debated in hushed tones among financial experts. A question that's quietly haunting financial circles, keeping economists up at night. It's a question that challenges our fundamental understanding of economic health and stability. Does the United States, the world's largest economy, need a recession? Is a period of economic contraction a necessary evil, a bitter pill that must be swallowed for long-term prosperity? It sounds absurd. A proposition that seems counterintuitive to everything we strive for in economic policy. Why would anyone, especially policymakers, deliberately want job losses, the very thing they are elected to prevent? Why would we willingly inflict economic pain on millions of families and shuttered businesses, the lifeblood of our communities, the engines of innovation and growth? The idea of intentionally causing such widespread hardship seems almost unthinkable. Yet, some economists, often those with a longer-term perspective and a focus on structural issues, argue that a recession, while undoubtedly painful, is the only way to truly fix deep-seated problems in our economy, problems that have been festering beneath the surface for years, masked by short-term fixes and unsustainable growth. Imagine the economy as an overgrown garden, a place where unchecked growth has allowed weeds to choke out the desirable plants, where resources are being misallocated and productivity is suffering. In this analogy, a recession is the harsh frost that kills off weak growth, the inefficient businesses and unsustainable practices that have been propped up by artificial stimulus. This painful process is supposedly making room for healthier plants, for more innovative and productive enterprises to emerge and thrive in a more competitive environment. But that frost doesn't just kill weeds, it's indiscriminate in its destruction. It wipes out delicate flowers too, the promising startups and small businesses that are just beginning to bloom, the vulnerable members of society who can least afford to bear the brunt of economic hardship. A recession is a wrecking ball, a blunt instrument that can cause widespread damage. It's not a precision tool capable of targeting only the unhealthy parts of the economy while leaving the rest untouched. For decades, driven by a desire to maintain stability and avoid short-term pain at all costs, we've avoided allowing these natural corrections to occur. We've consistently flooded the system with easy money at the first sign of trouble, artificially suppressing interest rates and encouraging excessive risk-taking. Now the problems have grown so large, the imbalance is so deeply entrenched, that the cure, a potentially severe recession, feels almost as terrifying as the disease itself. We're caught between a rock and a hard place, facing a choice between two unpalatable options. That's the dilemma we face in the summer of 2025, a critical juncture where the decisions we make will shape the economic landscape for years to come. To understand why a recession is even on the table, we need to look at the bigger picture. It's not just about isolated incidents or regional downturns, it's about a global phenomenon that has been building for years. We're talking about a level of interconnectedness that makes every financial decision, every economic policy, and every market fluctuation a potential catalyst for widespread instability. You need to grasp the scale of global debt. It's a number so large it's almost incomprehensible. It's not just government debt or corporate debt or individual debt, it's the sum total of all of it, across every nation and every sector. This debt has been accumulating for decades, fueled by low interest rates and a seemingly insatiable appetite for borrowing. $315 trillion. Let that number sink in for a moment. It's a figure that dwarfs the GDP of even the largest economies in the world. It represents a massive obligation, a future claim on resources that may or may not be available. That's 3 times the world's annual economic output. Imagine trying to pay off a credit card balance that's 3 times your yearly income. That's the situation the global economy is in. It highlights the sheer magnitude of the problem and the potential consequences if this debt cannot be managed effectively. Debt can fuel growth, and for a long time it did. It allowed businesses to expand, individuals to invest, and governments to fund essential services. But like any stimulant, its effects are temporary, and the long-term consequences can be severe. But much of this mountain isn't building anything productive. It's not creating long-term value or generating sustainable income streams. Instead, it's been used to finance speculative ventures, inflate asset prices, and prop up industries that are no longer competitive. It's propping up bubbles and unsustainable spending. We've seen asset prices, particularly in real estate and the stock market, soar to unsustainable levels, fueled by cheap credit and speculative investment. This creates a fragile system vulnerable to sudden corrections and market crashes. We've created a system addicted to cheap credit, where borrowing has become the default option for individuals, businesses, and governments alike. This has created a culture of instant gratification and short-term thinking, at the expense of long-term financial stability. And now the bill is coming due. Interest rates are rising, making it more expensive to service existing debt and take on new debt. This is putting a strain on borrowers, forcing them to cut back on spending and investment, which in turn slows down economic growth. 10% of global output goes just to paying interest. That's a significant portion of the world's resources being diverted away from productive activities and towards simply servicing debt. It's a drag on economic growth and a constraint on future prosperity. When rates were low, this was manageable. The burden of debt was relatively light, and borrowers could afford to keep borrowing. Now, rising rates are pushing households who are already struggling with inflation and rising living costs closer to the brink. Companies, particularly those with high levels of debt and weak profitability towards bankruptcy, and even countries toward default, threatening the stability of the global financial system. Every major default risks a chain reaction, threatening the entire financial system. The interconnectedness of the global economy means that a crisis in one country can quickly spread to others, creating a domino effect that is difficult to contain. We're living in a house of cards, built on a foundation of debt and unsustainable spending, and even a small shock could bring it all down. A sudden spike in interest rates, a major corporate default, or a geopolitical crisis could trigger a cascade of failures leading to a global recession. That's why some argue only a painful reset, a recession, can break our addiction. A recession would force businesses and individuals to deleverage, reduce spending, and reallocate resources to more productive uses. It would be a painful process, but it could ultimately lead to a more sustainable and resilient economy. But is that really the only way out? Are there alternative policy solutions that could mitigate the risks of a debt crisis and promote sustainable growth without resorting to a painful recession? That's the question we need to be asking. How did we get here? Our economic policy is dangerously one-sided. Governments and central banks are quick to intervene during crises, flooding the system with money. But when times are good, they rarely pull back. No one wants to be the buzzkill. This creates a cycle. We stimulate during downturns but never tighten during booms. Cheap money flows everywhere, fueling zombie companies and speculative bubbles. We're so afraid of short-term pain that we've created a chronic long-term illness. That's why the question of a needed recession keeps coming up. In theory, a recession is the economy's way of clearing out the deadwood, forcing bad businesses to fail so resources can be used better elsewhere. It's creative destruction, painful, but necessary for renewal. But in reality, recessions are blunt instruments. They don't just take out the weak, they destroy healthy businesses and livelihoods too. The human cost is immense. Millions lose jobs, homes, and security. The trauma lingers for years and not everyone recovers. A recession isn't a clean reset, it's widespread suffering. The textbook model is far messier in real life. That's the brutal truth behind the detox argument. History shows both sides of recessions. The dot-com bust of the early 2000s wiped out billions, but forced tech to refocus on real innovation. Giants like Google and Amazon emerged stronger. The 2008 financial crisis, however, was catastrophic. Reckless lending and housing bubbles triggered a global collapse. Millions lost jobs and homes. Recovery was slow and unequal. Yes, some corrections happened. New regulations, less speculation in real estate. But the cost was enormous and trust in the system was shattered. Unlike the dot-com bust, 2008's pain was everywhere and lasted for years. Recessions can correct excess, but they can also spiral out of control. You never know how far the fire will spread. Today, the global economy is on edge. The debt pile is still there, but now we've added trade wars, like new U.S. tariffs on Chinese goods. Tariffs disrupt supply chains, raise prices, and create uncertainty. Businesses freeze hiring and investment. Layoffs are already hitting tech and retail. Official data lags, but the pain is real and growing. Europe and Asia are teetering on recession, dragging down U.S. demand. High debt, rising rates, and trade tensions are a perfect storm. Some argue this shock could force a reset, but it's a desperate gamble. The risks of a synchronized global downturn have never been higher. In the complex world of economics, sometimes drastic measures are proposed to address underlying problems, but are these measures truly effective, or do they risk causing more harm than good? A controversial question often arises: should we deliberately trigger a recession to fix the economy? The argument for such a drastic approach often draws a parallel to medical treatments. It's like chemotherapy, a painful, grueling process, but deemed necessary to eradicate a life-threatening illness. The idea is that a recession, while undoubtedly difficult, can purge the economy of its excesses and imbalances. The goal is to kill the cancer of bad debt and rampant speculation that can cripple long-term economic health. By inducing a contraction, proponents argue, we can force a necessary correction. But the reality is that recessions aren't precise instruments. They are blunt forces with unpredictable consequences. They're sledgehammers, not scalpels. You can't finely tune a recession to only impact the areas you deem problematic. You can't target only the reckless financial institutions or the overly leveraged investors. Everyone gets hit, from small businesses to families struggling to make ends meet. Deliberately causing a recession is not only arrogant, assuming we can perfectly predict and manage the outcome, but also incredibly dangerous. Once the wheels are set in motion, policymakers often find they can't fully control the fallout. The situation can quickly escalate beyond their initial projections. The global financial crisis of 2008 proved that. It demonstrated the interconnectedness and fragility of the modern economy. Once a downturn starts, fueled by fear and uncertainty, it can spiral far beyond anyone's intentions, leading to unforeseen consequences and widespread hardship. Fortunately, there are better tools at our disposal, more precise and less destructive methods for managing the economy. These include targeted regulation, designed to address specific vulnerabilities in the financial system. We can also implement smarter taxes designed to incentivize productive behavior and discourage excessive risk-taking, and robust antitrust enforcement to prevent monopolies and promote fair competition. These strategies require patience, careful planning, and political will, but they're far less destructive and more sustainable in the long run. Calling for a recession is often the lazy way out, an admission of defeat in the face of complex challenges. It's akin to burning down the house, a drastic and irreversible action with devastating consequences. It's like burning down the house because you don't want to clean it, an absurd and ultimately self-destructive approach. Recessions don't hit everyone equally. The wealthy and big corporations often weather the storm, or even profit by buying up assets on the cheap. For ordinary workers and small businesses, a recession is devastating. Job loss means financial ruin, not just inconvenience. Safety nets are often inadequate, and the stress can last for years. Small businesses rarely have the reserves to survive a prolonged downturn. When someone argues for a needed recession, they're really arguing for a policy that hurts the vulnerable and benefits the powerful. It's a transfer of wealth from the bottom to the top. That's the real cost of a recession. So, what's the alternative to a recession? We need smarter, targeted policies, stronger financial regulation, higher capital requirements, and taxes on risky speculation. Governments should run surpluses and pay down debt during booms, not just spend and bust. Central banks must be willing to raise rates when needed, even if it's unpopular. We must address inequality, strengthen safety nets, invest in education, and ensure a fair tax system. A broad, prosperous middle class is the foundation of stability. The choice isn't between a painful recession and an unsustainable boom. It's about careful maintenance, smart regulation, and shared prosperity.